Good morning and welcome to the OPG Power Ventures PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to Simon Hudson from Tavistock. Good morning to you.
Good morning, everyone, and thank you very much for joining us. The presentation this morning will be delivered by Ajit, CFO, who needs no introduction. Also joining us this morning is Jeremy Warner-Allen, who's Deputy Chairman of OPG, and Russell Kerr, who has recently joined OPG to provide what he describes as in-house broking services. So I'll let Jeremy and Russell introduce themselves because I know most of you haven't met them before. So Jeremy, why don't you start?
Thank you, Simon. Firstly, may I welcome everybody to today's meeting, and thank you very much for sparing the time to hear OPG's story. For the past 5 or 6 years, we've been paying down debt assiduously in terms of dealing with the banking arrangements which we had, and these debts occurred as a consequence of building up the assets which we have in Chennai today. This is really the first sort of set of numbers which we've had, which indicate the strengths of the business in terms of its cash generation, profitability, and also the functions or the efficient functioning of the plants itself, which we've enjoyed for some time. I think I'd also like to say Avantika Gupta is unfortunately unable to attend the meeting today, as there is some issues which she has to deal with, which aren't related to the business, but means that she cannot come and be with us all today. So she sends her apologies for that.
Yeah, my name's Russell Kerr, and I've had a career in broking. So Investec, Beeson Gregory, Senkos were the companies I worked for. So really in smaller companies. So a big focus on smaller companies throughout my career. And what I'm doing now is working with a few companies, including OPG. And I sort of turn it in-house broking. I call it investor relations, if you like, but a little bit more to it than that, because really we're discussing with the board and discussing and using my experience and looking at the market. I know some of you want to discuss this later on, of how to get the shares moving, because it's a quandary at the moment with a lot of small cap companies, how to generate interest and generate volume in the shares. So it's really looking at that on an in-house basis.
So without further ado, I think that we should go through the presentation. So if I can bring in Ajit here, who is the company's financial officer, chief financial officer, and he's got a presentation which you will run through now.
Thank you, Jeremy. Thanks a lot. And welcome to all the investors for this investors meet. So this is opening slide. In fact, we have started our company in 2005, and we are principally operating in southern state of India, that is Tamil Nadu. That's called Detroit of India. We got our company listed in name in 2008. And till now, we are predominantly supplying directly to industries and commercial customers. And also some of the generation we are supplying to state utilities. We have 4 units in our plant and quite flexible configuration of 4 units. Total capacity is 414 megawatt. And probably we are one of the least leveraged company in the sector in India compared to our peers. Our market cap as on 1st October was around 40 million pound. If you see the economic growth in India, that's considered to be one of the fastest growing economy in the world, as against global GDP growth forecast of 3.2% for the current year FY25. India is expected to grow at around 7% as per IMF latest forecast. And next year FY25, India is expected to grow at 6.5%. Government of India has taken a lot of initiatives like Make in India, Vocal to Local, digitization, and also productivity linked incentive to encourage the manufacturing sector, particularly solar panel manufacturing and data center, semiconductors. So these are the various initiatives taken by the government. In terms of power sector, if you see, as of now, also the per capita consumption in India is around 1395 units per person, which is around one third of the global average, one of the lowest. So there is huge scope for further growth in electricity sector. Peak demand in FY24-25 has increased to 250 gigawatt, and it is expected to increase now to 270 gigawatt. In terms of total capacity, if you see, India has a total capacity of around 442 gigawatt. Out of that, 43% is from renewable resources and 57% is from fossil fuel. Whereas fossil fuel contributes to 75% of the total generation. Despite capacity of 57%, fossil fuel continues to be a dominant component in India's energy mix. And the sector is expected to increase to around 3 to 4 times in next 10 years, as per the latest estimate from India Energy and Climate Center. These are the key drivers for increasing power demand in India. 24/7 power for all, smart cities, housing for all. These are the push being made by the government of India. A lot of industrial push, increasing urbanization as well as heat waves, infrastructure requirement, and government push on electric mobility and overall strong economic growth. If you see the coal price movement, predominantly we are importing from Indonesia, and that ICI 4 index, which is 4,200 GAR coal. And here I wanted to show the movement of coal prices. Now it is more or less stabilized. Coal prices moved upward to the extent of 154.6. If you see in October 2021, that was post global conflict between Russia and Ukraine, and then it started stabilizing. So now it's stabilized at around $54-55.
Yes, just to sort of add to that, if I may interject here, Ajit.
Sure.
As you see from the from the price of coal, we've been through some very volatile periods, and it looks like the coal prices are now stabilizing, if not stable. I would add that throughout this period, the company has managed its processes extremely well, and despite these very, very severe increases in input prices, we've continually generated cash and remained profitable. And in fact, this is very unusual when you look at Indian power producers. Back to you, Ajit.
So this is our business model. Out of total capacity of 414 megawatt, 1 unit of 80 megawatt is tied up with the state utility under long-term arrangement, and balance 80% is being supplied either on merchant basis or to group captive customers or to various other state utilities on short-term basis based on the tariff. We have a very strong in-house O&M team to manage the flexible operations. And also the plant is quite flexible to use different grades, different types, different origin of coal. So we use from 3,000 to 5,000 GAR coal. And also from various origins, we use Indian coal, Indonesian, South African, Australian, Russian, Mozambique. So a lot of different grades and different origin of coal we can use in a blend. So that's the flexibility our plant has. Now I'll bring it FY24 numbers. So if you see in terms of generation, in FY24 we generated 2,322 million units as against 1,528 million units in FY23. That's a remarkable increase in FY24, primarily because of the increased demand. in India. And if you see the tariff has come down in FY24, average tariff, primarily because in FY23 coal prices were high, and that's why government has allowed a pass-through of higher coal cost, which is not available now, and that's why average tariff has come down, but PLF has increased substantially. So last year, FY24, we operated at a PLF of around 70%. In terms of revenue, if you see, in FY24, revenue has grown up by around 2.65 times compared to FY23. In FY23, revenue was 58.7 million pound, and in FY24, we did a revenue of 155.7 million pound. And adjusted EBITDA was around 10.7% at 16.7 million in FY24 compared to 16.5 million in FY23. In FY23, there were some exceptional items also, one-time gain like from coal sale as well as from some insurance claim which we received in FY23. So that's why these numbers are not comparable. Around 4 million one-time gain was there in FY23 from coal sale as well as from insurance claims. If you see PAT has come down from 7.3 million in FY23 to 4.1 million in FY24. For the regions, as I explained earlier, there was a one-time gain in FY23 for around 4.1 million. And earnings per share was 1.02 pence in FY24. Now, talking on debt level, we have reduced our gross debt from 32.6 million in FY23 to 28.6 million in FY24. And if you see net debt terms, in FY23 net debt was 9.3 million, and in FY24 it was net cash for around 3.59 million, which includes restricted cash as well. So both numbers are comparable. Both FY23 and FY24 numbers includes the restricted cash. Basically, the cash given to the banks for opening letter of credit or bank guarantees, which is our money.
Just one thing, just to sort of inform everybody, the term restricted cash really relates to funds which we hold for purchases of coal, but they are company funds, so they are included in the total of net cash.
And this 28.6 million gross debt, this is two components. Around 23 million is term debt and balance is working capital debt from the lenders. And gross debt is repayable in next 4 years. So by FY28, based on current repayment schedule, we should be debt free in terms of gross debt also. So this is the summary for FY24. Our revenue increased by 97 million. That's a growth of 2.65 times. Company maintained its focus on profitable generation. Total generation was 2.3 billion units. That's 69.2% PLF. Adjusted normalized EBITDA was 16.7 million. Net cash was 3.6 million as on 31st March 2024. And NAV was 42.3 pence as on 31st March 2024. Some of the factors on ESG. So we continue to focus on all three components of ESG: environment, social, as well as governance. In terms of environment, we are using air condenser rather than water, which saves a lot of water for operating our plant. We have also developed around 37% green belt in our plant. And one of the initiatives we have taken to plant bamboo, which we can use as a replacement of coal. So on test basis, we are doing now. And if successful, then we can grow at a larger scale. That is on environmental front. In terms of social, we continue to focus on providing education as well as health in the area where we operate. And in terms of governance, we have a very strong board and executive management to run the company. Here I'll take you to the outlook, future outlook. So very strong existing asset base. We have 414 megawatt thermal asset. Well positioned because strong electricity demand in India, and that's continued to increase. And still we are at very low per capita consumption of electricity in India. That's 20% of European Union consumption. decreasing debt profile. So we have reduced our gross debt also in the last year by around 4 million, and we expect to reduce another 4 million in the current year. We are sitting on a net cash of 3.6 million as on 31st March, and probably we are one of the lowest geared company in the sector in India. Future potential, we can increase generation, so we have potential of increasing generation as well as revenue. We continue to focus on profitability and our profitability margins, and we also have potential to grow further in the segments. We'll speak later on this, where we can put some solar or new things which we can add in our ESG agenda as well. In terms of current operations, India's power consumption is expected to grow by around 8% in 24, and plant load factor we expect to continue at around 70% for our plant. And we continue to explore various options for selling electricity, including short-term as well as medium-term, to various state utilities. So earlier we were operating only in the state of Tamil Nadu. Now we have started supplying electricity to other states. That gives us better margin and higher PLF. Our priorities: first priority is cash flow, to maximize our cash flow from the existing assets. Second, safety, environment, and performance. That's our priority. We are zero TRR company and ESG focus strategy. And sustainable and deleverage. We continue to focus on maintaining capital discipline and deleveraging the balance sheet. So, as a conclusion, very highly cash generative asset we do have in the company. One of the lowest geared companies in the sector. International coal prices have stabilized, which gives better forecast in terms of PLF as well as profitability. Overall basis, India's outlook is improving, and low per capita electricity consumption, as explained, at around 1,390 units per person. For the company, India continues to be our focus area, and we'll continue to operate in this geography. And if you compare our valuation, it is very attractive compared to listed Indian peers. So we are at an EV to EBITDA of around 2.3, 2.4, whereas our peers are being traded as around 14, 15 EV to EBITDA ratio. So very attractive valuation if you see from the company's point of view.
Okay, thank you very much.
Presentation. Yeah, now we can open for question answer.
Perfect. Ajit, Jeremy, Russell, thank you very much indeed for your
Well, I'd
presentation.
just like to say, if I may, thank you very much. That's a very comprehensive presentation. And if you look at the results for last year, as you will see, that we can been generating cash for around about £20 million per annum, and providing markets in terms of coal input prices stay the same, output prices. There's no reason why that sort of number cannot be going forward. It's now time for questions, and we'll take any questions that anybody may have. Over to you, Simon. I think it is. You are in charge of those.
Thank you very much, Jeremy. Well, the first question is a bit of a catch-all. So, Ajit, I think it starts with you. Could you please provide shareholders with a bit of an update on market estimates for the current year? Following that, some thoughts probably from you, Jeremy, on dividends, share buybacks, and returning cash to shareholders. And finally, have you seen any interest from potential external buyers of the company? So, Ajit, over to you for the first bit.
Thank you, Simon. So, as guided earlier, we estimate the revenue for FY25 at around £160 million, with an average PLF of around 70%. EBITDA we are expecting in the range of 13 to 14 million. That's around 8.5% of our total operating revenue. EPS is estimated as 1.1 to 1.2 pence. And although the company is committed to deleverage its balance sheet as its first priority, we, executive management along with board, is evaluating various growth projects as part of energy transition initiatives like bundled solar, battery storage, bamboo as a replacement of coal, data center, and semiconductor manufacturing. Company's executive management and board are also evaluating and working on return to shareholders, either in the form of dividend or buyback. And subject to requisite approvals and regulatory compliances, we expect to finalize the same before end of this financial year. As far as I am aware, or as far as we are aware, there is no plan or discussion we are having with any external buyer for the company.
So,
Jeremy, anything to add on that?
well, I was just going to talk about, to refer to your question earlier regarding dividends, buybacks, or indeed any other activities which we may have. So to set this sort of scene, if I may, the last 5 or 6 years have been extremely hard work for the company. They've been management and the executive team have been working extremely hard in quite difficult circumstances on occasion, particularly during the COVID period, high prices of input costs, and so on. What it has demonstrated is the company can deal with shocks, is very resilient, and has always generated cash, which is the most important thing of all, really. Being able to pay one's bills, being able to fund everything, and keeping the business stable. And we're now in a happy position of coming out of that phase. There's still more we'd like to do in terms of strengthening the balance sheet. However, having said that, I think it's fair to say that the board is very actively considering what to do next. And it may form 3 prongs or a combination of all 3. One could be acquisitions. We would like to do some of those in due course. Returning money to shareholders is very important, whether that be through dividends or through buybacks, whether that be tender offer or simply taking action in the market is another matter as well. And so we wish to remain flexible. Our operations are flexible, and we wish to take advantage of what is best for the company and its shareholders at the appropriate time. But there is no doubt the company is generating good profits and good cash. So on an as-is basis, you can see that the company will be generating in, I don't want to put any particular numbers, but the same, assuming everything is as is, in a couple of years, our market cap will be met by cash effectively, which is a very important thing to state. So I think that's all I can say on that at this juncture.
Thank you, Jeremy. The next question probably plays to Russell's expertise. What steps can you take over the coming year to try and boost share price performance? And what changes do you think you could make to the makeup of the share register?
Yeah. So a bit of background on what I know from my time working with smaller companies. If I go back, and I think everybody on this call probably is aware of the liquidity issues with smaller companies, but let's put some colour on this of what's happened. If I go back 20 years, there were 120 small cap funds that were happy to invest in companies of any market cap. And that would include the likes of Standard Life, Legal & General, all the big names who had small cap funds that were happy to be active in the small cap space. Now, the regulators got involved over the years, and they came in with liquidity rules, which meant risk departments in these big funds really said to the funds, you've got to be able to exit these positions in 2 days. And that just doesn't apply to smaller companies. So what's effectively happened is they are increasingly vacating the space of traditional small cap. And by that, I mean, in the UK now, really to have institutional interest, you really need a market cap of 100 million or over before we can get proper institutional doors opening for a company, which means that it's very important to have that target in mind of getting to a point where we've got institutional interest. Now, there are still funds who will play in the smaller space, but they are increasingly specialist. And so when you've got a company with a market cap of around about £40 million, what you have to work out is how, and it's clearly cheap. This is clearly good value. If we look at the multiples, this could go up threefold and still look cheap versus its peers. We need a period of stability from the P&L for the company to provide for investors, so they know that that asset performs and how it performs. And what we need to do in terms of marketing is find the people and find the funds who will invest at this market cap. Now, that's not as easy as it sounds, because, for example, that we all know the issues of liquidity in smaller companies. If you went along to a fund whose unit size was £2 million, they'd struggle to deal in OPG without finding stock from maybe the family or one or two of the larger shareholders. So they'd struggle to deal in OPG. So what we need to do is target our marketing, institutionally target our marketing at funds that can invest £200,000, £300,000, where they will find liquidity, perhaps over a week, perhaps over 2 weeks, but they'll be able to get a position in the company, because liquidity is very thin in OPG at the moment. So you can't really deal in the shares. Now, in conjunction with that, and I think Jeremy's just mentioned it, Arjit just mentioned it as well, you need to look at buybacks, and you need to look at housekeeping of your own share price in the marketplace. And that might mean that the company could put in place an order to buy back shares in the marketplace, which is going to mop up those bits and pieces of retail stock and mean that there's always a buyer for that, which means that the market makers aren't sitting there concerned about being able to offload book positions. We'll probably get a bit technical here, but the market makers, they will have limits as well about how long they can go in any particular share. So we can buy that stock off them. Why can we buy that stock off them? Because it's a better use of company cash than putting it in the bank, because we can get better returns on OPG stock. So it's the right thing to do for shareholders. So it's a combination of things, of micromanagement of the share price to try and get things moving. If we can get to the promised land of having a market cap of 100 million, then we open the door to institutional shareholders. Believe it or not, this is we used to laugh about it. This is the strange situation you live in, that they're not interested in companies with a market cap of 20 million, but they will be interested when it's gone up fivefold to 100 million. And this is the weird world we live in of institutional fund management. And so it's about understanding that and designing our marketing strategy to fit the new marketplace that we live in.
Thanks. Thanks, Russell. Next question. There's been a large background seller that's been offloading shares for a couple of years, says this poster. Who are the sellers, and why haven't there been any reporting on this and market updates?
I don't think that's entirely correct, that statement. There was one large institutional seller, but that was dealt with some 2 years ago, 18 months, 2 years ago. And that stock was placed. Subsequent to that, there has not been really very much movement in the shares, and the actual trading in the shares has been relatively thin, to put it in any terms. So I'm not aware of, the board's certainly not aware of any large seller at all. The family certainly aren't selling stock. We were speaking to the other major shareholder yesterday. He's not intending to sell any stock. So in one fell swoop, we've got something approaching 65% of the company, which is firm. And the other institutions which we know of and have spoken to during the course since the results, there's no indication whatsoever of them selling stock either. So I think the background is fairly stable and is poised to do quite well. Having said that, there are occasionally some very odd trades which go through the marketplace, which we've been investigating. And these refer to algorithm traders who put in marks at various prices, often in extremely small numbers. In fact, I found one trade which dealt in literally one share. And this can only mean that there's one mark going in at a price, and that's to keep prices suppressed. I've taken this up with the stock exchange and got a very poor response from them, in all honesty. But be that as it may, we're not concerned about any shareholders selling at this price at all. And if there were, I think we could make buyers for it.
Thank you. Ajit, question for you. Why did distribution and G&A expenses increase over H1 2024 and H2 2023? And can we expect this expense line items to revert back to historical figures? And second question there is, what's the projection for gross margins in the coming periods?
So as I mentioned during our presentation, that last year we started supplying electricity to various other states. Till FY22, we were focusing only to supply electricity in the state of Tamil Nadu. So when we are supplying electricity to other states, that levies higher transmission charges, that is interstate transmission charges, and that's why our selling and distribution expenses have increased. There was some one-time write-off of receivables also, which is showing increase in G&A expenses. So going forward, we expect the selling and distribution expenses to be on the same level because we are primarily supplying to other states.
Okay, thank you. The next question is actually about Tavistock, so I guess I'd better answer that one. It says that the PR company...
Sorry, but there was one more question I think you asked.
Oh, okay, sorry.
So gross profit is expected to remain in the range of 18% to 20%, and EBITDA in the range of 7.5% to 10% going forward.
Thank you. Next question is saying that what does Tavistock do for you? When I contact them, I get very limited replies, if anything. Well, I hope you contact me. My email address is simon.hudson@tavistock.co.uk. So please drop me a line. You'll see from my signature when I reply to you, which I will, that my mobile number is on there as well. Do I pass on investor relations queries to OPG? Yes, of course I do. Next question is, are any research notes provided by Tavistock? And the answer is yes, I will happily provide notes that are put out into the market by Cavendish, which is currently the only provider of research on the company. And those are available on Research Tree. But if you are not registered with Research Tree and don't want to, then I will happily send them to you. Next question from the same person. It seems that OPG has a clear investment case: surging power demand in India, thriving economy, 414 megawatts of power, valued at a fraction of its replacement cost. The company's profitable, yet its equity trades at 1/10 of its levels from 10 years ago, and you've paid off quite a lot of debt. What can be done to change the way that you approach trying to ensure that the share price reflects the value and prospects of the business?
Perhaps I should answer that. It's a fair question, and one which has exercised the board of directors quite considerably. We recognize that the market has changed in small companies, but it's equally fair to say that there have been a few hiccups en route with OPG, and disposing or passing back the Gujarat assets did cause a lot of problems for us as a company, and it certainly didn't help our relationships with the banks and so forth in India. Having said that, we have focused on our cash generative assets in Chennai, and those have been very, very robust. And I think by and large, we're through those problems. And I think this is probably the first time the board has felt comfortable in properly engaging with the marketplace to discuss the future and to discuss the prospects for the business going forward. It's a very flexible operation. Historically, we used to sell our power to commercial operators within Tamil Nadu. However, the prices and the inconvenience of that wasn't necessarily right for the current marketplace. Hence, we're now selling our power interstate. Obviously, that entails a lot less activity in terms of customer maintenance and so on and so forth, and costs which relate to that. So we are flexible. That's part of the beauty of the business, which was set up in 2008 on this on the basis of being able, as an independent operator of power companies, to sell our product wherever and whenever the demand arises, and to whomever, providing we get paid. And that's a very, very strong arrow to have in our quiver, if I may put it in those terms. So that's where we are at the moment.
And I think one of the things that a question I asked of the company months ago was, I'm very aware, as all investors are aware, of a lot of the delistings that are going on in the London market, particularly on AIM, which are very, very painful for investors when they happened. And one of the questions I asked of them is, are you committed to retaining the listing and being a listed company? And the answer is an emphatic yes. And you won't see OPG delisting. And so you can put that, the fear of a delisting for the retail investor and for the institutional investor. And I think the company can reassure that that's not something that's going to happen. Fully committed to a UK listing.
Thank you. Would the company consider a dual listing in India, given the differences in valuation for power companies?
Perhaps I could take this one, Ajit, if that's okay. We have investigated listing in India, but there's no fungibility between the two listings. So the listing in India would trade at one point, and the price in the UK would probably remain different. We also have to have reason for a listing in India. We would have to raise a certain amount of money, say, for argument's sake, 50, 60 million pounds, whatever. We'd then have to do something with that. There'd have to be a reason for that listing. And at this moment in time, we have funds. We're very well resourced in terms of cash, and it would be a bit pointless at this juncture to actually list in India. And the companies and the shareholders, the majority of the shareholders' wealth is in the UK listed quoted company. And so therefore, if there's no fungibility, how would that be reflected in India? And that's a very difficult question to answer. So I think the answer is we monitor it, but I don't think there's anything which we're going to be doing anytime soon in that regard.
So basically, just to add what Jeremy said, in India, you can list easily the company which is incorporated in India. So like the companies OPG Power Generation Private Limited or Geeta Power, which is the holding company, that listing can be explored in India, but not for the OPG Power Ventures PLC, which is domiciled in Isle of Man and listed in London.
Absolutely. Thank you, Ajit.
Thank you. At a previous IMC, the company discussed growing 18 acres of bamboo to be burned in the plants. This sounds like a bit of a distraction from your core business. Wood is very low energy density and costly to process. If such a project is continuing, is there a business case built around it, and can that be shared with investors? And is there a green carbon credit type argument around it, perhaps, that justifies it? Now that the coal prices have normalized, is it really worth pursuing?
Yes, so at the current coal price also, it's worth to use this bamboo. Maximum we can use only 15 to 20% of our coal requirement, which can be replaced with bamboo. And bamboo has twin benefits basically. It gives the security, of course, we are not dependent on import. And second, it is environmental friendly, so we can get carbon credits during cultivation of bamboo, as well as when we are using in plant as a replacement of coal. So as of now, it's in pilot stage. We'll see the results and then we'll take a decision whether we have to grow at a larger scale.
Does the company have any comment to make on future strategy and on perhaps setting out a commitment to a percentage of profits delivered back to shareholders via dividends or indeed share buybacks?
Just going back to my earlier statement, really, it could be a hybrid: acquisition, dividends, share buybacks, all three. And I think I'll answer that question earlier, if that's all right.
I think you did. Next question. Could I ask what the terms are for the solar debentures and when does this get monetized and what will happen to the proceeds?
So those debentures, I'm not sure you are asking for the solar debentures held by OPG or the OPG debentures. So I'll answer both. OPG has issued debentures for around 3.2 million, and those are redeemable as bullet repayment in FY 26-27. Those are listed in India, and that's why you see the quarterly results update in Indian stock exchanges for the Indian company. Second, the debentures of solar entities held by OPG, that OPG continues to hold. Those are for 10 years period and at a coupon of 6.5% to 8%.
Okay. Thank you. The next question is, and I think, Jeremy, you've answered this. There is a thought that the company isn't doing enough to promote the attractions of OPG because there is a plan to take it private by the majority shareholder. Do you have any thoughts on that?
It's not something which is ever discussed at the board. We have, in terms of the family wishing to take the company private, so it's nothing further I can add to that which we already discussed earlier.
Thanks.
On table for taking the company private. So that is, at this point in time, it is not being pursued.
More questions on dividends and share buybacks, which I think you've answered. Do you think you are subscale in a capital-intensive industry, and what can you do to address that?
Well, I think it's that's something which we do recognise. But having said that, we would like to be a bigger operation. In fact, had we still managed to maintain the Gujarat assets, we would indeed be, twice the size of that which we are now. So the company has ambitions to grow. However, we do want to make sure that what we do doesn't put us in a position which jeopardizes shareholders in any way, shape, or form. And the management team are interested in growing, but it has to be on terms which are more sustainable than perhaps we had with the Gujarat lenders at that point in time. And that's quite difficult to arrange in India and with the state banks. So I think it's going to be largely a matter of a bit of DIY, but I think we can do that, and I think we can make progress in becoming a bigger business.
And I think also in valuation terms, while we talk about the Indian sector 10 to 15 times EBITDA, there are some companies, there's realism here. There's companies that are a lot bigger than OPG, so we can't expect to be on the same multiple as the big companies. but we can certainly expect a little to close the gap quite considerably on them, because the gap is too large at the moment. So yeah.
But there's also, in terms of looking at the market, the electricity market and power generation market, there is a case for having a smaller operation. We don't want to be, a massive company in that sense, with dealing with sort of 1.2 gigawatts or anything like that. But that would be problematical for us. So, but there is certainly a very good market for being able to react flexibly to demand spikes and to also customers who require electricity on a permanent basis and on a reliable basis too. So there is a market for us, and that's why we've been successful, I think, in surviving some very difficult times.
And I think I'm right, Jeremy Adjett, in saying that the cash flows that the company produces, if you were to pursue something of an acquisitive strategy, it might not necessarily be in additional capital intensive businesses. It could be in businesses that have a much lower capital requirement, that are allied to primary energy production, as opposed to being directly primary energy production. So it's something that the cash flow provides flexibility for.
But there are no current plans to do anything at the moment.
Thank you. Are the non-exec directors shareholders, and would they consider buying more shares?
Well, that's a good question. I think I've got something approaching just over 1 million. I can't remember the exact number, and I've bought them at higher prices than this. I will often consider doing so, and I'll do that when it suits me to do so.
Thank you. Are there plans to add another research provider, such as Equity Development or Progressive or one of the brokers, who will provide paid-for research?
Yeah, I mean, yes. The answer is yes. All things are open for discussion. If it's going to add value, if it's going to add to for people's ability to understand the company and buy the shares, then yeah. I'm all for having 2 forecasts out there rather than 1. We will extend the duration of the forecast as well, which I think is important for investors. So yeah, anything to make that journey for investors easier.
Thank you. As a utility company, most long-term investors, pension funds, etc., would expect to see a growing dividend payout. What's your view?
I think that's not necessarily. This is only my personal view. It's not been really discussed at the board yet. We haven't set a dividend policy per se. We've been concentrating on removing the debt burden. But on a personal view, I would say everybody would like to have a consistent rising dividend policy, but life isn't quite like that, and we live in quite volatile times. What we would like to do is to pay dividends as and when we can afford them, and to pay them out with a smile on our face. And that's important, and that's where we're moving towards. Or we would be buying shares back, as discussed previously. One way or the other, we would like shareholders to be rewarded for their patience.
Question from Harry. How can results be released on BSE in India first, but are released later in the UK, where you're listed? I think he's referring to the Indian operating company.
Yeah, sure. So there are 2 different entities. In India, as I mentioned, there are some debentures which have been issued by Indian entity, and those debentures are listed in BSE. And pursuant to listing guidelines in India, we have to give quarterly results in Indian stock exchanges for Indian entity. Those are standalone results, and we have to give within 45 days from the end of each quarter, which we are complying. Those debentures are repayable as bullet repayment in FY 26-27, and post that, those debentures will get delisted. and we continue to release the results based on the compliance requirement in India, only for the standalone company. For London Stock Exchange, the regulations I think are half-yearly results, and that on consolidated basis, and that's what we continue to do. So that's why there is some time gap difference because of the different company as well as the different compliance requirement.
Okay. I think that answers, that deals with all of the questions. There's a couple more on would the Gupta family consider buying out the company, and you've already answered that one. So I think that brings the Q&A session to a close.
Perfect. Thank you very much, Simon, Ajit, Russell, Jeremy. Thank you for addressing those questions for investors today. And of course, the company can review all questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Jeremy, could I please ask you for a few closing comments?
Just like to thank everybody for listening to OPG's story. We're determined to continue to make OPG a more investable proposition for people, and I think the results will be well, we're trading reasonably well at the moment, so I can't see there being any shocks, regarding where we are in terms of market estimates at this juncture. May change, of course, but that's where we are today.
Perfect. Jeremy, Ajit, Russell, Simon, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of OPG Power Ventures PLC, we would like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.